Okay, this is what we're going to be covering for the next 15 weeks. It's called the accounting process. So we're going to, the first step is analyzing, and this is how a business, we'll look at what happens in a business and how things affect each other when we analyze. We're going to be recording, putting into an accounting system. We're going to group all related things together, accounts together. We're going to be classifying. Then from there, we're going to summarize the results that have happened after we grouped all these accounts together. And we're going to make a report. And the financial reports that we make a trial balance, we make an income statement, statement of owner's equity, and a balance sheet. Okay. And then this is interpreting, people that are in the business world or banks, whoever is looking at your business, they can take these financial statements and they can tell the health, or if your company is doing poorly, they can tell that too. So that's why they use these financial statements. We also will be breaking down what we do into quarters or into yearly. And the reason they do that is so they can do comparisons. They can compare this quarter to last year's quarter at this time and see our sales, increased or decreased, or if we had more expenses, what's going on with our business, and we compare it from year to year. So that's why we have different accounting periods. To make all this work, we use what we call GAAP, and these are generally accepted accounting principles and procedures and guidelines that must be followed during the accounting process. And you have, big, thick books on GAAP, on what are the acceptable accounting principles. And they're used to ensure everyone prepares and interprets financial reports the same way. That's the only way it's going to work as far as one business or another, or banking institutions looking at a company. If everybody's on the same playing page, then you know that you're looking at apples and apples and not apples and oranges or whatever. Everybody's looking at the same thing. Now, all these principles and guidelines that they do all come from what they call an accounting equation. And the accounting equation is composed of assets equal liabilities plus owner's equity. Now, each component, we have assets, that's anything that the company owns. So, for example, some of the accounts, and that handout that I gave you, if you flip to the next page, you will see the accounting equation there for you. You will see certain accounts that are under each of the categories. Okay. So assets is a category. It's anything that's owned by the company. So for example, if I put cash into my company, I own that. My company owns that. Okay. And if I take cash that is personally mine and I put into my company, it's no longer mine personally, it belongs to the company. You have to keep everything separate. If I have an automobile that is mine personally, and when I start a business, I put that automobile into my business, it belongs to the business. It no longer belongs to me personally, okay? So you've got to keep everything separate. Petty cash, that's where you may set up $100 that you want to keep in a cash box in your company, and they have a system so that if you take, let's say the Girl Scouts come in and they want you to buy some Girl Scout cookies. Well, you take it out of petty cash and you fill out a little receipt, so when you give them, how much is Girl Scout cookies now? $4, okay. $4 a box, then I'm going to give them $4, but I have to document it, and I put it back in there. And my petty cash box has to keep at $100. So if I have used 4 of it, then I have 96 in there plus the $4 receipt. I have $100 back. It's always going to equal whatever amount I set up my petty cash. Okay, the cash in there plus whatever receipts I have. Accounts receivable is when customers owe us money. When we do business with customers, sometimes we allow them to buy things from us and they charge from us, okay? And we set up accounts receivable. So any account that ends with the word receivable, you'll always know is an asset. If it ends in the word receivable. So we have notes receivable. This is where a customer might give us, if they're going to pay us in 60, 90, or 120 days, they give us a promissory note. It's actually a written note where we put it under notes receivable. Because accounts receivable is usually every 30 days. It's paid off within a 30-day period. If you have a merchandising company, right now we're going to start with a service-oriented company. So that's like an attorney, an accountant. They're providing a service for you. Toward the end, we're going to do a merchandising company, and then we have to keep up with the merchandise that we buy from a vendor, put in our store, and our customers come in and buy that product. Okay, so we will have merchandise inventory is considered an asset because that merchandise does belong to us. Prepaid rent, usually whenever you either lease a building, you're going to have to pay rent. And so they normally have you pay it 6 months or a year in advance. Well, you still own that because if you leave after 2 months, depending on what your contract reads, the person might be responsible to giving you back the other amount that you haven't used. So you set up what's called prepaid. And then as that rent becomes used, the part that becomes used becomes an expense to the company. And we'll be talking about that in Chapter 5. But anything that's a prepaid, is an asset. So anything that ends in receivable, anything that starts with prepaid, is an asset. Prepaid insurance, again, if you have liability insurance on buildings, if you have automobile insurance, you pay for that in advance. And then if you get rid of that vehicle, just like in personal, they refund you part of the money that has not been used. So we set up a prepaid. Supplies, we have to have office supplies, and so we go out and we buy that. We put it in a store on some place we keep all of our office supplies. And as we use part of that supplies, the part that becomes used is an expense to our company. But when we buy it and put it in there, it's an asset. As we use part of it, the part used becomes an expense to the company. Okay. Then those are called current assets, and then you'll notice I have plant, property, and equipment, and some places call them different things, okay? But these are more long-term assets. So this is if you have any equipment that you bought. And when you have equipment, just like an automobile, when you buy an automobile and you drive it off the lot, what does it do? What do you always say? It depreciates. You use some of the value of it. So the same thing happens with what you buy for your company. So if you buy, let's say, a dump truck or some type of equipment, then you're going to have to depreciate it. And the reason they allow you to do that is that it helps you because you can take this off your taxes, and so therefore it lowers what you have to pay for taxes. And so they think with that money you save, it helps you rebuy equipment and stuff. Okay. So an automobile, you would have accumulated depreciation with it. If you had furniture and fixtures, it would have depreciation also. One thing I'd like for you to mark on this sheet of paper is that equipment is an asset account. Accumulated depreciation equipment is called contra, C-O-N-T-R-A, contra asset. Contra asset. So the equipment is the asset, and then there's a depreciation is a contra asset account. I'm going to use a little T account.
So the ones that have the ACC.
That means accumulated. Anything that has accumulated is going to be a contra asset account. Very good, Linda. And I'm going to use a T account. We're going to use these later on, but I'm just going to tell you that with a T account, is just simply drawing a T. You have the account title up here, and then the left side of the account is debit, the right side of the account is credit. That's all debit and credit means. Debit, left side of the account, right side of the account on a T account. The rules will tell you which side you record on as far as if you're trying to increase or decrease this category of account, okay? So if I buy a piece of equipment and it was $10,000, after that first year, let's say it depreciates $2,000. Well, then I'm going to use its accumulated depreciation account, and I'm going to record that $2,000. And I'm going to keep every year, I'm going to keep recording it until it equals, the balance of this account equals $10,000. And when it does, actually this equipment really has no value. It still may be usable, but it does not have any value as far as being added in as an asset. Okay. But We want to keep what we pay for the equipment, we want to keep it separate. We never want to mess with this amount unless you're selling it. Because at that point, you need to know whether you've had a gain on the sale or a loss on the sale. So we always want to take its depreciation through the contra asset account, okay?
But wouldn't you, okay, say you bought that equipment, and you say your company decided to sell it, you would go to the figure that you had.
Well, you would have to
Depreciation.
record, you would have to get rid of the depreciation and the equipment, whatever you sold it for, and you've got a gain or a loss. And that's something that we look at if you do the regular accounting course, they get more into that, okay? But right now, what I want you to realize is that when on the balance sheet, when you record this information, we look at what is the book value of the equipment. Well, if it's $10,000, what we bought for it, but at this point we have $2,000 that depreciated. The book value, what is actually valued for this company, is $8,000. And then the next year, when we add another $2,000 for depreciation, now it's only valued at $6,000. Okay, so that's a book value.
Entering anything under the credit for the equipment then?
Do what now? Oh, we'll get to that later. Okay, what we're gonna debit and credit on it. Okay, I just want to show you what book value is right now. Okay. Okay. Also, these accounts are known as either permanent accounts or temporary accounts. And permanent account means that an account's balance will move from one accounting period to the next accounting period. We want the balance to roll over. If I'm in business and I have a cash account, wouldn't I want that balance to follow me every accounting period? Okay. But we have some temporary accounts that tell us what's going on during one accounting period, and we want to zero those accounts out so that the next accounting period, they will tell us the same information. That's where our comparison comes in. So we have permanent accounts and we have temporary accounts. The assets are considered permanent accounts. And you can also write on the assets above it, they are not only permanent, but they also appear on the balance sheet. So they're permanent accounts. You can just write them above here when you're talking about your assets. They're permanent accounts and they appear on the balance sheet.
You need profit and loss statements too.
Profit and loss is the income statement. Okay, is the income statement.
So with the items down in like the plant and property where they're like the equipment is an asset, would that be?
Yes, all of that, and all that part that's under assets, all this part right here, these are all assets under here.
Right.
But these are current assets and these are considered long-term assets. Okay. Okay, let's move to liabilities. Students get liabilities and expenses that we have under the owner's equity section. You get these confused. Okay. So liabilities, they appear on the balance sheet. They are permanent accounts. Liabilities appear on the balance sheet and they are permanent accounts. Liabilities you have to create. So if you buy something from a vendor, we're a business, we buy something from a vendor, a product or something, and we tell them that we will pay them later, okay? That's going to be accounts payable, and that's usually 30 days. Just like accounts receivable, accounts payable is when we owe money to someone. And anything that ends in the word payable, that's a liability. Anything that ends in the word payable will be a liability. So on your sheet, you see that we have accounts payable, salaries payable. We use salaries payable because at the end of the accounting period, a payday may be split between two different accounting periods. And so we always have to match all revenue with all expenses in the certain accounting period. And so sometimes a payday gets split between two accounting periods. And so we need to make sure that we count the expenses properly. So sometimes we need to set up a salaries payable, that we owe some salaries. Notes payable is again where we give someone a note that we will pay them in 60, 90, 120 days. And then we have a long-term liability, a mortgage payable, such as if we bought a building, usually it's 30 years, just like when we buy a home, 15, 20, 30 years. So you'll notice all of them have in the word payable. But we created these. We went out and we had to go with another company and tell them we were going to do this and we were going to owe them money, okay? Keep that in mind. Then we have owner's equity. Under owner's equity, we have one permanent account. Capital is a permanent account. This account tells you what you really have ownership to, because assets, whenever you sell your business, your creditors, the people, liabilities have to be paid off, and then you get the rest of it. So assets minus liabilities would equal owner's equity, what you really have right of ownership to, because creditors have to be paid first. But the capital account is a permanent account. We only use the capital account in about 4 situations. It's when we start our business, because whatever we put in our business, we own it at that time, okay? Because we really don't have any liabilities when you first start your business usually. If you make an additional investment, you decide after 6 months you need to put some more cash into your business, that's an additional investment. So we have to use the capital account for that. We use it when we record our net income or net loss, our profit loss that you were talking about in accounting period. We need to put that in there. And we use it also when we close in the closing process, when we put our withdrawals in there. Withdrawals is when the owner takes out money for personal use, okay? So capital account will only be used 4 times in all the transactions that we have, and it is a permanent account. It goes on the balance sheet. If it's a permanent account, it's going to appear on the balance sheet. Now we come to the other 3 accounts that are under owner's equity. The withdrawal account, or sometimes you'll hear me refer to it the drawing account. That is when the owner takes money out for personal use. They would draw money from their company, and now it's their personal money. We have the revenue account. That's what we're in business for. We're selling either a service or we're selling a product. And whatever money we gain from those sales, that is revenue to the company. And it's a temporary account. Withdrawal, revenue, and expenses are temporary account. They're used for 1 accounting period. We'll close out their balance, and they'll start the new accounting period with a 0 balance, because they're going to show us if we made a net income or net loss. Okay. Expense accounts. Expense accounts are because you're just in business. If I turn on, I have to have electricity. I mean, it's not something, I have to go to the electric company and get it. But if I didn't have a business, I wouldn't, it's just on the regular operation of the business. So, gasoline to run the truck that you bought or the automobile repairs that you have to make, those are expenses. Water, gas, electric, those are expenses. Salaries are expenses. Okay, so that's the difference between the liabilities and the expenses. And again, liabilities is always going to end in the word payable. And expenses always going to end in the word expenses, okay, for the account. So it's salary expense. What are some of the others I have? Did I put some down? I didn't put any down. Office expense, and supplies expense, repair expense. It's going to have an expense, okay? The withdrawal account appears on the statement of owner's equity. The statement of owner's equity. And in this textbook, they usually do a statement of owner's equity. If you don't do a statement of owner's equity, it can be included in the balance sheet. But in this text, they do a statement of owner's equity. What a statement of owner's equity does is show the changes in the capital account. It shows the money that's been taken out for personal use. And it also shows net income or net loss in that area, statement of owner's equity. The revenue and expense accounts, they're also temporary. And they will appear on the income statement or the profit loss statement. That will show us if we made income or lost income in our business. Okay. So any questions so far? Linda?
The capital part, where you're saying that these are permanent, and I just wanna make sure I have everything that you're saying. I understand that you have your beginning investment, and you said that this would only show the capital stuff, there's only 4 things to it.
No, it's only 4 transactions that involve capital
You have the
account.
beginning investment, and then you have that additional investment. But then down here, what I, of course.
Well, it's on here. It's on this sheet here.
But
Okay.
you've got it as like closed, so. the
Close net income or net loss and drawing. That's a step whenever you get to the end of your accounting period. There's 4 steps you have to go in, that you have to do in order to close your temporary accounts to get them with a 0 balance to start the next accounting period. So, but you do 2 separate accounts, 2 separate transactions. You close net income and net loss, and you close drawing. That makes the 4 transactions.
Okay,
You understand? Okay.
so drawing, actually,
You close the drawing account or the withdrawal account into the capital account. That makes the 4. Mhm. Any other questions? Okay, if you'll flip over to the next page, before I go there, I mentioned this, but we can look at the accounting equations in different ways. Assets would be the liabilities plus, would equal liabilities plus owner's equity. Assets minus liabilities equals owner's equity. Assets minus owner's equity equals liabilities. So it's just different ways to look at the accounting equation. But we mainly use assets equal liabilities plus owner's equity is what we use. Okay, these are the 5 steps that are in your book. And then whenever we look at a transaction, I'm going to drill you. Whenever we read a transaction, I'm going to say, what are the accounts involved? That's the first step. Then I'm going to ask you, what is the category of the accounts? And you're going to tell me it's an asset, it's a liability, it's a capital, revenue, expense, whatever it is, okay? Then the third step, I'm going to ask you, are you trying to increase the balance of this account or decrease the balance of this account? And you're going to determine what you're trying to do to this account balance. Then once you do that, number 4, then you have to, what is the rule? Do you debit or credit to increase or decrease this particular type of account? And then the last one is record the transaction. So every time that you look at a transaction, you want to go through these 5 steps. Okay? Now, a transaction can be a transaction that is called, we have an in-house transaction. We do that during the closing process, okay? During those 4 steps that I talked about that affect a capital account, we do that in the closing process. And then we have what we call arm's length. Arm's length transaction means it's between my company and someone outside my company, an arm's length transaction. The other one is the other 4 are in-house transactions. We're going to be mainly dealing with those arm's length transactions until we get to the end of the accounting period. Then we need to do those others, the in-house ones. Whenever you do a transaction, no matter whether it's arm's length or whether it's an in-house transaction, there must be 2 accounts involved. Must be at least 2 accounts involved. If there's only 2 accounts involved, then one has to be a debit and one has to be a credit. Because whatever you do to one side of an account, you have to do to another account, but on the opposite side, in order for the accounting equation to work. Okay. So if you have a transaction, it will have at least 2 accounts. One will be a debit, one will be a credit. There is something called compound transaction where you may have 3 or 4 or 5 accounts involved, and then once you get them all recorded, the debits must equal the credits. If that's true, then your accounting equation will work. Okay. Now it is possible that your debits and your credits equal, but you put it into the wrong account. You understand? Because you may choose another account that you increase on the credit side, and that will be caught usually by customers. Just like when you get your bill and you know something's wrong on it, you call the company and they find out they've made an error. And that's how most things are found, because someone else has let you know there's a situation, okay? Also, we do a statement that's an informal statement called trial balance. And all the trial balance does is make sure your debits equal your credits. That's the only thing that that particular document does. Debits equal your credits. Okay, let's go to our accounting lab. And if you look in your textbook, we're going to do Sanchez, start Sanchez together. And this is on page 75. Everything will be in my accounting, all the instructions and everything, but I want us to look at what's in the textbook first until, so you can get used to this. Keep your handout handy, okay, because you can flip and look at different accounts. It'll help you with your categories. And I'll be going over the 5 steps, so I'm going to be drilling you over those 5 steps as we go through here. Now on page 75 in your textbook, you see first that we have chart of accounts. This is simply a listing of your accounts, and they list assets with a number 1. So it could be 100, but these they have 1,000, but it will start with the number 1 for asset. We usually list assets in the order of the liquidity. So we list cash first because it's already in cash. We have, if you have a petty cash, then we're going to do petty cash would be next. Accounts receivable, because you can sell your accounts receivable to someone else, and so it's a liquid, it's pretty liquid. Then supplies. You could sell off your supplies. You may not get very much for them, but you could sell off supplies. Office equipment, you could do that. So it goes down from your most liquid to your least, okay? Then liabilities will always start with the number 2. Owner's equity, you'll have capital, and you'll have your withdrawal account. Those will be with a 3. You have revenue that will start with 400, or 4, sorry. And expenses will be 5. Expenses will be 5. When we have a merchandising company toward the end of the semester, then we'll be adding another category. Okay. But for right now, these are the categories that you'll be using. We're going on the assignment at the bottom of page 75, you're going to be using T accounts. So we're going to use T accounts like we have up here. And we're going to record the transactions K through S. Chapter 1 did A through what? A through before we get to K, all those, they were done in chapter 1. So those balances were brought forward. So you'll see that we'll have some balances in some of the accounts. That's because of chapter 1. We're also going to foot and take a balance of the T accounts. I'll talk to you about that when we get to that part. And then we're going to prepare a trial balance and the other financial statements, an income statement, a statement of owner's equity, and a balance sheet. Okay, so let's go to our My Accounting, and let's go to Sanchez, Chapter 2, Sanchez. And then you'll see it says continuous problem, so you want to check on that. And if you want to expand your screen, go ahead and expand your screen. Has everyone got it up? Everybody okay?
My mom does accounts payable, and she has 2 computers that she'll, it's easier having the 2 large.
This is during July. This is the first month of operation. Tony Friedman, owner of Sanchez, created the following chart of accounts. So you'll see here we can click, and again we look at, here's the chart of accounts that are in the textbook. I'm going to close that. And then here is the transactions for, these are the ones that were done in chapter 1. These were already done, and that's why we have some balances in some of our accounts. You'll see that cash account, remember, this is, we're in August now, and so this is the second month, but notice how cash and supplies, these are assets, computer, their balances rolled over, okay? And we had, I don't know if we had any expenses at this point. We had some withdrawals. We did have an expense. So until we close out the period, these are going to roll over until we close out the accounting period. And then in August, these are the transactions that we have in our textbook. Now you'll notice over here that you have a calculator on the right-hand side. So if you need a calculator, you can do that. After you try, and here's a help me solve it. If you're having some problems, it will help you solve it. I think you get like 3 tries, and if you don't solve it, it puts the answer up there so that you can get some instant feedback on what you're knowing and help you learn. So we've already went through the transactions. We're going to be recording these. And it tells us, let's see. Okay, record the transactions K through S in the T accounts below using the transaction letters as posting reference. Foot each T account and then calculate the account's ending balance at August 31st. And it says use the first line below each T account to foot each side of the T account, including zero balances. Use the second line below the T account to enter the account ending balance. So they're talking about here that we'll be footing it and then we'll be putting a balance. And here's a sample they show you. Here's a footing where they have put the balances and then they record the balance. And we'll talk about that, how they record the balance. But they give you lots of resources. So I'm going to put my August transactions back up here. It might be easier for you, since you can look in the book and see the transactions, you may want to have the chart of accounts showing up here so you can see your assets and everything right away. Okay, let's read our first transaction. It says received the phone bill for the month of July. Now, does it say that I paid it? Does it say paid? No. If it doesn't say you paid something, then that means that you're setting up where you owe the money. Okay, it's not, not paying it right now. You'll pay it at a later date. So I'm going to go through the 5 steps with you. Looking at your chart of accounts and knowing that we received a phone bill for the month of July for $155, what 2 accounts do you think would be involved in this transaction?
Accounts receivable and cash.
Accounts receivable and your cash account. No, not accounts receivable.
Payable.
Payable. Accounts payable. Okay, what categories do these fall under?
Liability and asset.
We have accounts payable is a liability, but we're not paying it right now, so we're going to put it under expense account, phone expense, okay? We record expenses at the time they occur, not the time we pay them. And the same thing with income. We record income at the time we receive it, not when we actually get the cash. So if a customer buys from us and they charge from us, that's considered income, even though we haven't received it yet.
Okay. Wouldn't that go under like the phone expense?
Pardon me?
But you said it's a phone.
There's phone expense right here.
Yeah, so it's gonna
So the 2 accounts involved are phone expense and accounts payable. Phone expense and accounts payable. Now, let's talk about how do we know what to debit and what to credit. We have some rules. And if you will think of, I've got something that will help you remember these. We have A, W, E. That's assets, withdrawals, and expenses, all A, W, E. The rule, if it's an asset or a withdrawal or expense account, remember I'm drawing a little T account, left side's debit, right side's credit. To increase any of these accounts, If you categorize as an asset, a withdrawal, or expense, you increase it on the debit side. So I use the arrow or plus sign, whichever is best for you. And to decrease it, we use the credit side. And I'm going to give you this, LCR, liability, capital, revenue. If it's a liability, a capital, or revenue account, this is the rule. We increase on the credit, decrease on the debit. You can remember that, and you'll be able to record transactions.
Really, credit and revenue?
Yeah, credit, yeah. Liability, capital, and revenue.
Capital revenue.
Increase on the credit, decrease on the debit. So we've decided that we have accounts payable. What kind of an account is accounts payable? It's a liability. Okay. Now, what are you trying to do to this liability account? Are you trying to increase what you owe or decrease what you owe? Increase what you owe, because we received the phone bill and we're not going to pay it right now, so we're increasing what we owe. So we're trying to increase this account. What is the rule to increase a liability account?
Credited.
We would credit it. Okay. The other account that we said was involved was phone expense. Phone expense is what type of account?
Liability.
No, it's an expense.
What's it end in?
It's an expense.
What does it end in?
It's an expense.
Expense, phone expense, expense account, okay? Expense account. So what are you trying to do? Are you trying to increase what you show how much you paid in phone bills or decrease? You received a bill, you haven't paid it yet. You're trying to increase, you're trying to increase, okay? So what is the rule to increase a expense account?
The debit is increased.
To increase,
You increase the debit?
increase expense account, debit. That is correct. So we have an accounts payable, it's a liability, we're trying to increase, we're showing that we owe more money, so we're increasing the balance of that account, and the rule is to credit. We have an expense account, we're also showing that we're increasing the balance on it, because when I get through with my accounting period and I look at the balance of phone expense, it's going to tell me that I have paid $500 in phone expense, okay? So usually every time an expense account is involved, it's going to be an increase, because you want to see by the end of the accounting period how much I spent in gas, how much have I spent in water bill, how much have I spent in phone expense, okay? So most of the time they're going to be in a debit.
So meaning like it's always gonna go up?
It's always going to go increase. Mm-hmm.
So when
Okay.
it's basically when you're making a payment, you're showing that
We're not making a payment. We're not making a payment. Let's hold that off until we come to where we're making a payment. It says here that I received the phone bill.
Oh, okay.
And some companies, as soon as they receive a bill in QuickBooks, it allows you to put that bill in and then you pay it later. You set up when you're going to pay it later. Okay? So let's record this first transaction that we've done. We've identified what we need to debit and credit, and so we're ready to record the transaction. So we said that we were going to debit phone expense. So let's go down, scroll down till you get to phone expense. And we're going to put the letter for right now. This is not what we'll do when we start journalizing, but this is to help you learn the rules of debits and credits. And this was K transaction. And then we're going to put the amount, which was $155. We said we were going to use accounts payable, and we said that we were going to credit it, so we're going to put on the credit side, we're going to put K, and we're going to record $155. Remember, a transaction must have at least two accounts involved. This one had two accounts involved. One must be a debit, one must be a credit of the exact same amount. Okay? We debited phone expense, we credited accounts payable.
Starting to make more sense as we're actually doing it. Yeah.
Mhm.
Okay.
Okay, let's go to the next one. This is L. We paid $150 for insurance for the month. When it says paid, you automatically know cash is involved, okay? We paid something. So, what two accounts going through the 5 steps, what accounts are involved? Look at your chart of accounts and see whatever account might be involved.
What was the bill for again? I'm sorry.
It's for insurance.
So cash and insurance expense.
Insurance expense, good. Cash and insurance expense. Okay, now, let's go to what category. Cash is what type of account?
It's an asset.
It's an asset. Are you trying to increase the balance of cash or decrease it?
Decrease.
You're paying, so you're decreasing it. What is the rule to decrease an asset account?
Credit.
You want to credit it. The other account we said was insurance expense. What is a category?
It's an asset.
Insurance expense. What is a category?
Expense.
Expense, okay? What are you trying to do? Are you trying to increase the balance or decrease the balance? Increase, because we want to show how much we're paying in insurance. So we want to increase the balance. What is the rule to increase an expense account? We want to debit it. We want to debit it, okay? So we have cash, asset, we're trying to decrease it, it's a credit. We have insurance, expense. We're trying to increase the balance of this account to show how much we're paying in insurance, okay? And the rule is that you need to debit it. So let's go to these accounts. Let's go to the cash account. This is transaction L. The amount is $150. Then we need to go to the insurance account. It's on the debit side. We're going to put an L. $150. Always when you finish, make sure you have one debit and you have one credit. One debit and one credit. Okay, look in your book, and we have M, paid $200. What do you know immediately?
Paid it, it's cash.
Cash is involved, okay? The amount due from transaction D in Chapter 1. Okay, in Chapter 1, let's turn back and see what we did in oh, well, we don't have to. We can look up here on our July transactions in D. Click the icon to view the July transactions. This was what was done in Chapter 1. And this balance is already showing in the accounts, okay? So we're just looking to see what was done and now what we're got to do in August. We set up a new account with Office Depot and purchased $250 in supplies on credit. On credit means we owe somebody money, correct? Anytime we owe anybody money, what account do we use? A payable. Okay, so we have our payable account under our liabilities. So we have payable. So back in, now this is, don't do anything yet, but this was what happened in the Chapter 1. So they set up accounts payable and they bought office supplies, so office supplies would be involved. So they debited office supplies, which is an asset account, and they credited accounts payable, a liability account, showing that we owed that money. Okay, now we're in August, and now they say that we're going to pay $200 of the amount due from the transaction. Okay, in D, we charge $250. In August, we're paying $200 of what we owe. $200 of what we owe. So you got the scenario? You understand what happened? What's going on? Okay, now, we know, you said if it said paid, we know cash is involved. What type of account is cash?
It's an asset.
It is an asset. Are we trying to increase or decrease the balance of cash? Decrease. What's the rule?
Credit.
Credit. Okay. The other account involved is we've already set up accounts payable showing that we owed $250. How much of it are we paying this time in this month? 200. So what are we trying to do to accounts payable? Increase the balance or decrease it? Decrease it, exactly. So what is the rule to decrease a liability account? Okay, so there we have our debit and our credit. Okay. So let's go to our cash account. We will go to the credit side of our cash account. And this is transaction M. And we said the amount was $200. Now we go to our accounts payable because they're trying to reduce what we owe. So we're going to debit, and this is going to be $200. So now we don't owe as much money. We pay 200 of it. When we got finished, make sure your debits equal your credits. We have a credit of 200 in cash and a debit of 200 in accounts payable. Questions? Are you just confused and don't know what to ask, or you just?
But I think it's clear as mud now.
Okay. And as we go on, it should, become more clear. Okay, let's look at transaction N. It says paid advertising expense for the month, $1,400. What did we do?
It's a cash and expense.
Okay, all right, so we've got the two accounts involved would be cash. We're paying cash of $1,400. And what are we paying it for? Advertising expense, okay. Now, cash is what type of account?
It's an asset.
Asset. What is are we trying to increase it or decrease it?
Decrease.
Decrease it. What's the rule?
Credit.
Credit. The other account is advertising expense, type of account.
It's an expense.
Expense account. Are you increasing the balance or decreasing it? Increasing it because we're trying to show how much we're paying in advertising expense. What is the rule to increase an expense account? Debit. Okay, so we got our two accounts. So let's record them. We're going to credit our cash account.
1,400.
Yeah, and this is in 1,400. You don't have to put the comma in or anything. And we're going to go to our advertising expense. We're going to debit it. This is in 1,400. We have a debit and we have a credit. Okay, our next one. O, we billed a client for services rendered. So we performed our services for a customer and we billed. It didn't say she paid, we billed her, okay? So what account do we use anytime a customer owes us money? Look at your assets.
Receivable.
Accounts receivable, anything that ends in the word receivable, okay, is an asset, and this is the one we use when customers owe us money. Now, what are we trying to do to this balance? Are we trying to increase the balance or decrease the balance?
Increase.
Increase, because we're trying to show money that is owed to us, so we're increasing it. What's the rule to increase an asset account?
Credit.
Debit, okay? And our other account that we're going to be using is services rendered. That means that we
Service
received,
revenue.
revenue. We received money for what we're in business for, so it's revenue account. And our revenue account is called service revenue. It is revenue. What are we trying to do to its balance? Increase it or decrease it?
Increase.
Pardon me?
No, it'd be-
We're trying to increase it. We're trying to increase. If this is revenue, we're trying to.
You're showing that you're getting money.
It's showing what money we've earned from being in business. So, what is the rule for a revenue account to increase it?
Credit.
Credit. So now we've got our accounts, so let's record them.
This is just double entry accounting.
It's double entry accounting. Exactly.
Okay.
Exactly.
See, my boss, who runs the firm said when he got out of college, he still didn't even really understand it.
Ah.
And then one day, just all of a sudden, it came to him. He said he actually understood it.
It's double entry
He said,
accounting.
this is the biggest thing I learned.
Whatever you do to one account, or whatever you do to debit, you got to do to credit. No matter how many accounts are involved, it always has to equal. That's how the accounting equation equals. So,
Except for on QuickBooks.
except what?
QuickBooks cheats.
Oh.
QuickBooks just kind of does it for you.
That's $850. That's correct. Now, it takes the same amount of time to enter information into QuickBooks because you still have to enter the debits and credits. But once you get everything in there, QuickBooks will do your trial balance, your net income. It'll do all of that for you. Okay? So,
Catch your payroll.
Yep. all that. So we did accounts payable for $850, and we did revenue credit $850. Okay, I'm going to let you think about P. I want you to think about if you need to draw your little T accounts on a piece of paper, but see if you can come up with what you would do in the P one. Decide what T accounts you would use and what you would increase and decrease without me going through the 5 steps yourself. Don't say anything. I just want you to go do it and see what you come up with. It's collected $900 for services rendered. Collected $900 for services rendered. Don't say anything yet. Tell you something else about accounting. You'll either love it or you'll hate it. There's no in between. I see it in every class. I see some people that just can't wait to get out of this class, and I can see others that just can't get enough of it. So it's either one way or the other.
Stepmom loves it. I might have to go to her house, huh?
Yes.
Just until I get the hang of it.
Mhm.
Hey, can you even tell me?
But keep
Most people are scared because they think, oh, it's math, it's math. Well, if you can add and subtract, that's all it takes, you know. And it's the rules. That's the whole
We follow
problem.
the rules,
Is
yeah.
follow the rules, learn the rules. Okay. What 2 accounts did you come up with?
Cash
Cash?
and service revenue.
Correct. Cash, what type of account?
asset
Asset. Are you increasing it or decreasing it?
increase.
Increasing it. What's the rule?
Debit.
Debit. Service revenue, what type of account?
It's a revenue.
Okay, what are you trying to do to it? Increase it or decrease it? Increase it. What's the rule?
Credit.
You're trying credit. Anytime you've got revenue,
Because
that's what you're in business for. So you're trying to show how much you've made in your business.
So we got the cash for it, the service revenue.
Service revenue is a revenue account, and you're trying to increase the balance of that account.
Okay.
The rule is to credit.
Okay.
So we're going to go to the cash account. It's the first
It's not
one.
really increasing anything, it's kind of just showing you what has increased over the period. of time.
That's what I
You know
was
what I
going
mean?
to ask.
Like you go for each month and then, you know, you go back and you look at it, okay, this is how much I made in services revenue. Like, okay, I charged this much and got this much for these services.
So cash is the revenue.
No,
No,
Cash is the.
an asset.
cash is an asset.
The cash that came in was an asset. And showing the cash that came in, I'm going to debit it,
Yes.
okay? Then to show the revenue that came in for the services, I credit it because at the end of the report, what I'm showing is that this is the increase in the revenue.
Uh-huh. Anytime you get revenue, you're
That's
increasing your
money.
balance.
Yeah.
That's what you're in business for.
Okay, so I guess the thing for me is this one here, I guess it's confusing because you're saying we collected $900 for services rendered. And I understand that from, I guess, a consumer's, thing. But as an accounts payable when you're saying it goes into the cash, we're increasing the cash we gained, and we're also increasing the revenue we gained.
Yeah, it doesn't matter if both of them are increasing because the rule takes care of it. One of them to increase the account you debit and the other one to increase the account you credit. That's why the rules, that's why, it's amazing how they came up with this.
I know, because it's.
Nothing's changed. I can tell you in 40 years, nothing has changed. This is it.
It's basic
This is it.
concept, but it's really.
But if you don't get this, you'll be lost from it forever and
Well,
ever.
that's why I'm trying to get it, because I don't want to be lost.
Well, I don't expect you to walk out of here. You have some really, it starts gelling, but until, a couple of weeks, I don't expect you to just really feel really comfortable with it. But you should be starting to feel somewhat comfortable with it now.
Accounts receivable would be money owed to you for services, right?
Correct.
So if they pay toward that money they owe you for the services, it does not come out of accounts receivable.
Wait a minute.
Right? Or would it? Because
No,
they pay you cash, but then it's.
Well, no, they paid you cash for services rendered. They didn't charge anything. They didn't charge anything. They had $9 of services. They paid $900 of services.
accounts receivable is like something you charge someone and you don't collect the money.
The statement will read the client was billed or is on credit.
Right.
That will tell you to set up to accounts receivable
Or it's send an invoice out to the.
or send an invoice. Right. But most of the time they'll say that it was on credit or that they were billed, and then you have to use accounts receivable and the revenue account. When it's paid, then you use accounts receivable and the cash account. Okay, let's go to the next one.
We're like,
Okay, now
We're gonna try.
this one, Q, involves something that was done in chapter 1. Okay, so I'm going to look up on my transactions in July, and this involved transaction H. So in chapter 1, the electric bill was due but unpaid. Okay, so at that point, we showed it as utilities expense. We debited utilities expense, and we credited accounts payable. That would have happened in chapter 1. Now, what's happening in this month, it says pay the electric bill in full of July, the July bill. Okay, so now we're paying it. So we had set up our accounts payable, now we're paying it. So what accounts are involved?
Utilities expense.
Cash and
Utilities expense.
what?
accounts payable.
Accounts payable, because we already showed it in chapter 1. When we got the bill, we recorded it as utility expense. The expense,
Okay.
remember, you pay,
That's
You-
what it's
Oh,
showing.
there it is.
Okay.
yeah,
Okay.
you put,
That makes sense.
we record expenses at the time they happen. So it means when we receive the bill, we record the expense. We don't wait until we get paid. When we get paid, then we just pay off the liability in the cash account. Okay, so we said we had accounts payable involved. What type of account is it?
It's a liability.
It's a liability. Are you trying to increase what we owe or decrease what we owe? Decrease. What's the rule?
Debit.
Debit. Okay. Then we said we had the cash account. It's what type of account? Asset. What are we trying to do? Increase or decrease the balance? Decrease. What's the rule?
Credit.
Credit. Okay, so let's go to cash account. You are doing great. Trust me, you're doing great.
She's saying that out loud with yourself, right?
Okay, but we want to incorporate the $85 that we had in the utilities expense.
No. It was already put into the utility expense in chapter 1 right here. This is that balance that's here in utility expense. This came from chapter 1
Right,
because the bill was already received, so it has nothing to do with this month.
so
That is-
what amount do we put in?
Well, it's $85,
That's what I
correct.
was
Oh,
wanting to make sure.
okay, yes, it is, you're paying it. So cash is going to be credited 85 and accounts payable will be debited 85. Always make sure debits equal credits when you get through. And that may not seem important now, but we will have compound entries, and you have 3 or 4 assets and two credits, so you need to make sure they're equal before you move on to another transaction. Okay, I want you to go to R, and I want you to do this on your own, see if you can figure it out.
Okay.
R, it says paid cash for $50 in stamps, for stamps. Okay, what 2 accounts did you come up with? Cash?
And postage.
Very good. Okay, cash, what type of account?
Asset.
Asset. Are you trying to increase it or decrease it?
Decrease.
Decrease it. What's the rule?
Credit.
Credit. Okay, the other one, postage expense. What's the category?
An expense.
An expense. Are you trying to increase or decrease it? Increase it. What's the rule?
Debit.
Debit. Oh, good. Okay, so go to our cash account.
No worries.
Just give yourself that one.
It's quick in a minute.
No,
Revenue for expense
yeah, it's postage. Not phone.
on the other side. No problem.
You're on the phone expense.
Do what?
You were on the phone expense right there.
Oh, I was?
Yeah.
Thank you. Yep. Thank you.
Can't be messing
There we
up
go.
our accounts now.
Yeah, because then that's when you get audited.
That's
Well,
true.
we'll just talk to our people about that.
That's something that I don't worry about.
We'll talk to somebody else about audit stuff.
Audit.
Oh, y'all catch me in mistakes, please do.
Well, we want your books
Well,
to
you
turn
know we
out.
will, I mean.
Y'all want me the rest of the semester, you want me hauled off, huh, for IRS?
No,
Tax evasion.
oh dear. Credit one. Oh, okay, you said that.
The last one.
So we debited postage expense, credited cash, $50. Okay, let's go to the last one.
Well, no, it comes out of office equipment, but the other portion.
Purchase $200 worth of supplies
Credit.
from computer connection on credit.
So,
Okay.
Hold it, don't say anything. Try to figure it out
Now,
first.
You know what paid.
I know.
No, that's not fair. Okay.
Y'all know the go-to person when I'm not here?
Because he's already doing it. Now, what are you doing in here?
I'm going for my master's.
Oh,
And going for my CPA.
So why are you taking this class and not at Clear Lake?
Because it's cheaper over here.
Yeah, but will it? Did you make sure
Yes,
that?
it transfers. I've already talked.
Really?
Mhm.
I'm surprised this one transfers and they didn't want you to take the accounting principles class.
No, this one transfers.
Oh, that's good to know. I didn't realize that.
oh, come on, I know what it is. Yes.
Well, it's a lot easier to take it here.
This is just intro to accounting, right?
Yeah,
1301.
I'm not entering anything if I don't have it.
no. This is you're in the wrong class. That's what I was wondering. Accounting 1311.
No,
Accounting 1301. That's entered.
no, 1301.
You're on 1303. Are you signed up for 1303?
Thursdays, 9:30 to 12:20.
Okay. I just want to make sure. And you checked with them.
It says intro to accounting.
Okay. All right.
on here.
Because this one doesn't go as involved as the regular accounting class because they go into partnerships and to
Yeah,
corporations.
they said go from here and then take the more advanced over there.
Absolutely.
I kind of just
Absolutely. You'll be ahead of the game, I guarantee you, because I've had students that took my class and then took the regular principals class here, and they zoomed through it because they understood debits and credits
Yeah.
so well, you know. Yeah, absolutely.
Well, 'cause, I mean, it's 150 credit hours for the degree I want.
Yeah.
You know, so
And you're going to be in a classroom of many, many students over there.
yeah, and it's a lot more expensive.
Yeah.
And gas.
Well, great.
is over there, so.
Yeah. So is oil and gas accounting on your degree plan? Oil and gas accounting?
No, I want to do public accounting.
Oh, okay.
You know, tax returns and then bookkeeping when we're not busy.
Yeah.
Like
'Cause that-
right now we're doing W-2s and estimates
Oh,
at
okay.
work, so
Mhm.
yeah.
Because oil and gas accounting was required on mine. I loved oil and gas
Yeah.
accounting. That was really, yeah, that
I'm
was really.
not sure. I haven't really looked into all the
She likes it.
classes.
Is she oil and gas?
Oh, yes, she's been there for,
Oh, okay.
since young.
Yeah,
That's all she's been doing her whole life.
I can understand that.
That's what my brother's a petroleum engineer,
Okay.
and so he travels the world,
Hmm,
you know, does oil stuff.
interesting. That's interesting. Okay, we purchased $200 worth of supplies from Computer Connection on credit. What two accounts are involved?
Computer,
No.
shop equipment,
No,
No,
auto supplies,
supplies. Supplies
and accounts payable.
and accounts payable, absolutely. It's because you purchased $200 worth of supplies. And then it says you were buying it from the Computer Connection people. And then it says on credit. That means you didn't pay cash, okay? So we got accounts payable, we have supplies. Supplies, what type of account? An asset. Are you trying to increase the balance or decrease the balance? Increase the balance. What's the rule? Debit. Okay, accounts payable, type of account? Liability, increasing or decreasing? Increasing, rule.
Credit.
Credit.
I got that, I just didn't get the name of the dog function. Oh, mercy.
You got it in your head.
Yeah, I will help my, come out.
that's why I think QuickBooks in a way kind of cheats. You know, I mean, it's like it doesn't really teach you the basics.
Absolutely. That's why I think it's good to do this because then you understand if something in
Yeah.
QuickBooks doesn't seem right, you sort of understand where to go and look and
Yeah,
find
well,
it.
that's what my boss said. He said, you know, you jump into QuickBooks and it does all the calculations for you. He
Right.
said, but I want you to be able to know
Right.
what it's calculating.
Absolutely.
You know,
Absolutely.
that's why it's.
Okay.
So that's why we do sort of the manual and then we bring in the QuickBooks
Yeah.
and
Could you, I hate to be, but I need to make sure I understand it on S. Could you explain to me?
hold on just a second. Let me get mine recorded here for just a second. Because if I start talking, then I will make a mistake, although I know y'all will catch it for me. Okay, Linda asked.
Okay. It's when, cause I know these are basically little word problems. How did you determine the accounts?
Because it said, we're talking about S, are we talking about the last transaction, is that
Yes,
correct? Okay, it said purchased, so that meant, well, I bought something, and it was worth $200, and it tells me what it was
It
supplies.
just says supplies, all because it says computer connection, because I was thinking the
It
same
said,
thing.
well, it
But
says
it says
supplies, but then it
supplies.
says worth of supplies from, it tells you who you bought it from,
Okay.
okay?
And you gotta remember
That's right.
supplies are
I
assets.
was overthinking it instead of just.
Yeah.
So
Yeah, supplies are assets
They
because
stay with you until you
Yeah.
use them.
because you keep the supplies in your storage and you use them, and then we're going to talk about chapter 5, what happens to the part that becomes used of your supplies. That's when it becomes an
Okay,
expense.
and then it went
Yes.
on to credit, which meant that we didn't pay for it straight out with cash, we kind of.
We charged it. We charged it. Mhm.
Oh, you
Yeah.
type.
Mm-hmm.
Put it on credit
Mhm.
cards.
Absolutely.
Which puts that in accounts payable.
Absolutely.
Okay.
Okay, now, any questions over those transactions? Let's go to the next step.
Okay, what is this?
Yeah, what is?
Right here, they tell us that they want us to, and then it says foot each T account. So what we're doing is we're trying to, right now, we can't really tell what is the balance of cash? We can't tell until what we call foot the account. Foot the account means you add the left side and the right side. Okay, so let's do that in cash. When we add these, I'm going to give you the amounts because I don't want to waste time. Our time is precious. So if we added this up, it would be 4,750. And on the credit side, it would be 1,885. Now, let me tell you something else about the accounts. We have what we call a normal balance of an account. A normal balance of account means that it is the side that has the largest balance on it, is the normal balance. And it is the side you increase on. So all these accounts here, assets, withdrawal, and expense account, they increase on the debit side. So the balance of the account should be on the debit side. That would be a normal balance for the account. If it comes up and it's one of these accounts and the balance is on this side, that's not normal for that account. And I ought to give you a clue. For example, if it's a cash account and at the end of the accounting period you come up with a credit balance, that's not good. Either you made some mistakes or you need to get out of business. I mean, you know what I'm saying. So the only thing that normal balance means is that it should be on the side you increase on for that account is a normal balance. So in this situation, we look at this account and we have a debit of $47.50 and a credit of $18.85. So that means that the difference between these accounts should be recorded on the debit side because that's normal balance for that account. Okay, because the debit side was larger. So the difference between those is $28.65. Does that make sense to you? The side you increase on is considered the normal balance side. Now, look at these sample T accounts again, because I normally, when I check mine, it'll come up and I haven't done something correct. They want you to make sure that you put a balance, even though it's zero, on the accounts before you figure out what's a normal balance, which side to record the balance on. So you understand? You've got to have something on each of these sides right here. So we're going to put 850 here, and we're going to put a 0 over here on the credit side. We find the difference between the two. It's 850, and it's on the increasing side, so we're going to record 850. So you think you can go through and foot the accounts for me? Okay, go ahead and foot the accounts for me. Oh, well, wait a minute. I'm sorry. I need to do it with you so you won't have to add. Well, most of them you can add. You shouldn't have too much problems.
Oh,
You add the top balance.
Cash has the most accounts in it, so.
and we just put zeros in all of, if there's no numbers at all, just put
If there's
zeros.
no numbers, just on where it should be put.
Up one. It should be where the 450 is. Because that credit balance will limit.
So I just carried that down.
Yeah, because there's nothing else in the account.
Zero.
Now pay attention to what you're doing. Don't get happy because you're doing all the assets and all that. They're all on the debit side, because when you move to a liability, you're going to be putting it on the normal balance side for it, which is a credit side.
So what?
It's like accounts payable the next one.
When you get to accounts payable, it's a liability. So its normal balance should be on the credit side. That's the side it increases on.
Because your accounts payable will technically be, well, not technically, but it'll be kind of negative in a sense.
Yeah, because you owe that money.
Because you owe that money.
Yeah.
Yeah, you owe that
Like
money,
I mean, it's not
but
really
Personal
But
credit card.
the purpose of that account is to show the total you owe, how much you owe. Okay, so we still owe $450, $405, excuse me.
And then you would put here.
Yes, that's reminds me of my credit card.
on your service revenue, it's $3,400. So you don't have to go through and add, it's on the credit side, it's $3,400.
But you see,
So I'm subtracting this and this.
yeah, and putting in on the 697. It's more, you know.
It's
All of
just
your-
fluid.
your in there. But yeah, you know what I mean, because that's the one that.
I shouldn't have it like this.
Yeah, see how it turns.
And again, we're just using the T accounts to learn the concepts. And then later on, we're going to be using journals and we're going to be using general ledgers. So they're going to look a little different, but it's the same process.
Oh, what did I do wrong?
Did subtract two.
Before you check it, let's go through it together. Make sure we've got everything as it should be.
So because it's accounts payable, what we can't pay out.
Yeah, so we still take, so next month, we'll owe $405 in accounts payable. That means we have $400 worth of bills that we haven't paid, that have been credited towards us, so we haven't paid.
So just continue.
Yeah, just bring them all down. Unless they have ones on each side of each row. Make sure you put your zeros in.
Okay, so in cash, we did our, on the debit side, $47.50, credit $18.85, and the balance on the debit side of $28.65. Accounts receivable, we brought down $850, zero on the credit side, back on the debit side for $850 the balance. Supplies, we brought down $450, and we have zero on the credit side. The balance is on the increasing side, $450. Computer shop equipment, we brought down $1,200, zero on the credit, balance on the debit, $1,200. Office equipment's asset, so we have $600 on the debit, zero on the credit, balance of $600. Accounts payable, liability, we brought down $285, and we have $690, and it's increasing on the credit side, so our balance should be on the credit side, $405. But what you're looking at is the balance here and the difference between the two, and then you record it on the larger side. So you just don't think it goes on the credit side. You've got to make sure you make that analysis because sometimes they're not normal. Freeman, we brought down zero, credit side $4,500. It's a capital account, increases on the credit, so we record the balance on the credit, $4,500. We have $100 on the withdrawal, on the debit, on the credit zero, and debit balance of $100. Service revenue account increases on the credit side, so we have zero on the debit, $3,400 credit, and record the balance on the credit, $3,400. Advertising expense accounts, we increase on the debit. We have $1,400 on the debit, zero on the credit, and balance on the debit, $1,400. Rent expense, debit $400, zero on the credit, balance $400. Utilities, $85 on the debit, zero on the credit, $85 on the debit, for $85 on the balance debit. Phone expense, $155 debit, zero on the credit, balance on the debit, $155. Insurance expense, $150 on the debit, zero on the credit, balance of $150 debit. Last one, postage expense, $50 on the debit, zero on the credit, balance $50. Got it? Okay. Now I think we're ready to check this. Let me look at our instructions again.
Wait, can you go to your postage real quick? Okay, so it's a debit.
Debit 50, credit 0, debit 50.
Your postage.
Did she record the R correctly?
No, Well, she put it in credit
Okay.
instead of.
All righty, let's check them. Uh-oh, see, I told you I'd have something wrong. Your posting for transaction S is incorrect. Please refer to the information provided and think carefully. What did I do or S?
Yeah.
Oh, I probably, if you forget to put the letter, that might have been what happened. Accounts payable. Yeah, no, yeah, I put an R instead of an S, I think.
Yeah.
I like that.
Yours is right.
Okay.
She
How many got your excellent? How many got your excellent? You got your excellent?
Yeah, I like that.
You okay?
So I hit,
Okay.
what do I hit?
Anybody not get it? I mean, if you need some help, or it shows you where your mistakes are.
Posting for transaction
R,
R's.
so just go look at your R's.
Okay, wait, do I hit this out? R with this. Paid cash.
So just check your cash. Okay, that's fine.
This is debit. See, R is here,
Yeah, that would go on the other side. Guys, remember?
because I paid
You're
paid
paying it.
cash, so
Yeah.
I took it out, so it's supposed to be later. So that changes all of it.
No.
No, wait a minute.
It's 350.
This R is supposed to be over here in the credit.
Yeah, you're right. It's just put 50. Delete that side.
Well,
Because it's already back.
Okay, now that we have sort of, oh, wait a minute, I think we still have to do the trial balance.
It's already back.
Okay, now we're gonna produce, okay, let's get them.
mine's giving me a problem.
Well, after so many times, it will tell you, I mean, it's gonna give you the answer and you can move
Carefully
on.
review your posting and make sure that you do not know.
It's all right. Just it won't.
I mean, it showed that she put zeros down, but then it showed that it didn't.
You have to put all the zeros in the balances too.
No. Yeah, I did, but.
No, I mean, just, she put them.
I missed one somewhere.
I think that's it. I think they're saying. That's weird.
I don't see it. Is there a letter there?
No, hers.
That was a carried
That was
forward.
a balance, it's above the balance, and
Because it
it's gonna be
says-
wrong, because I had the balance blank.
Wait, which one?
Anyway,
The
this is
accounts
your-
payable.
so we can move on.
It says 285.
It will show.
If I'm wrong, it looks the same thing.
Of course, why not? Anybody else in that?
Okay, we're going to go on to continue so that we could do the trial balance. Now, a trial balance, like I mentioned to you before, is simply taking all your debits and credits from your T accounts and putting them in one document to verify that debits equal the credits. That's the purpose. It's an informal statement. Trial balance is just to verify debits equal your credits. Got to see where we need to go. So what we'll do is we take the trial balance we'll list the accounts in the order of your chart of accounts. So we have assets, liabilities, capital, drawing, revenue, expenses. So it's going to be exactly the same as your chart of accounts. So what we have to do is go back up here. I was thinking they showed us. Okay. we take the balance of cash, which is $28.65, and we go to our trial balance. And our first account, we want to do cash, and we put the amount $28.65. Okay. Usually we have, let's see, check out. Yep. Okay. Then you take your next one, which was accounts receivable, $850. And that's a debit balance. So be careful as you go through, because when you get to liability, if you're going ahead, make sure that that balance is on the credit side. So be sure you're putting them on the correct side. Next one, supplies, $450. And computer shop equipment's $1,200 debit. Office equipment, $600 debit.
What was the C again? It's liabilities
Capital.
and revenue.
Uh-huh. Accounts payable is a credit of $405.
You know how you get that? Because if you go back to your teacher,
All you're doing is transferring the balances to to the trial balance in the order that they appear. How they appear is the same as they do in the chart of accounts.
so Paul's good.
That's why you need two screens.
Yeah, 74.5. But see, then you go to this one. This is on the debit side. See?
Freeman cap 4,500.
Yeah, you want to look at this chart. Your two charts.
Then when you do your drawing count, remember that balance is a debit balance, so go back to your balance, debit side. And your revenue's back on the credit side. You can use your calculator and add up your debits and then add up your credits. Just don't assume that when you add the debits that the credits are going to be the same. Make sure this is the purpose of this statement. Add your debits, add your credits. They should equal.
basic journal entry in a sense, isn't it?
What we're doing here?
Yeah.
No, the journal entry would be more like what the T accounts, except you do it in journal entry. Because journal entry is where you put the debit entry first and then the credit entry in a journal,
Oh,
not a T account, not a T
okay,
account.
yeah.
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 That or we were trying.
Whenever you get it done, if you'll raise your hand so I'll sort of know when people get finished. Thank you. Thanks, Kelsey.
Fast as I can move my little computer. After we've annotated all of this,
Add them up to make sure both sides are equal.
Okay.
So on this chart, you have to put zeros on this one? Okay, what now?
No. Because all you're doing is checking the single credits.
Okay, so now you go to the top of your chart. So that cash now, each column is there's no 60 grand.
Okay, let's check it and then I'll give you the total. Your cash on the debit side, you would have $28.65, accounts receivable $850, supplies $450, computer shop equipment $1,200, office equipment $600. Then we'll go to the credit side for accounts payable $405, capital $4,500, back on the debit withdrawal $100, back on the credit for service revenue $3,400. The remaining ones are debits, $1,400 for advertising expense, rent $400, utilities $85, phone $155, insurance $150, postage $50, and then we would add, and each of them would equal $83.05. $83.05. So are we ready to continue to the next step? Okay, is everyone, okay, I want to continue to the next step. Okay. It says prepare from the trial balance, an income statement, a statement of owner's equity, and a balance sheet for the 2 months ending with August 31st. That's because the T accounts have both the balance of July and they have the balance of August. We put in those August transactions. So we're closing it out at the end of August. Start by preparing an income statement. The statements, the formal statements, and even the trial balance, they all have the same heading. You start off with the name of the company, what this particular form is, and the date is different for different documents. The trial balance is on a particular day because we can say on August 31st, our debits equal our credits. You understand? On the income statement, we're trying to show if we made a net income or a net loss, whether we made a profit or a loss. So we're talking about a period of time. We're talking about July and August, okay? So we're going to start off by putting the company name, which is Sanchez Computer Center. This is an income statement. And then on the date, we want to put for the 2 months ended August 31st, okay, because we're showing the income we made over those 2-month period, that 2-month period.
So you're doing for the 2 months ended on August 31st.
That is correct. And then check.
July and August.
And now we have the income statement. Okay. The income statement is a formal statement. Again, it's a period of time that we're covering, and we're trying to show if we have a net income or net loss. So the only accounts, one more time, the only accounts that are put on the income statement will be revenue and expenses. You understand? Because revenue tells us how much money we brought in. Expenses, how much of that revenue we had to spend in order to make that revenue. So that's the purpose of this statement. So let's go ahead and record our revenue account. The amount is, here we go. And under that, we want our categories revenue. Under that, we want to put our service revenue, our account title, service revenue. Now, we have 2 columns here. The extreme right-hand column of a document of a statement will be for totals. Anything to the left are considered what we call working columns. Okay. So since we only have one revenue account, we're going to put the total out here on the right-hand side in the total column. So it's $3,400. Then our next section is called operating expenses. Operating expenses. And so we will list our expenses. We will start, and this is coming from the trial balance. Remember the trial balance. So we're just pulling the revenue account and the expense accounts. This is what we're dealing with, this section right in here. So I want you to take, I'm not going to give them to you. I want you so you will remember where you're taking it from. I want you to go up here, take your advertising expense, click on advertising expense, and then record the amount. So go through and record the expenses. And we're going to use the working column because we have several expenses that we need to add together.
So every expense.
Anything that ends with the word expense.
So we have 2 categories, revenue, and then we list the revenue account. Now we have the second category, operating expenses, and you list each of the individual expenses with their amounts in the working column. It's not a debit and credit column, it's a working column. As soon as you get all the expenses in, raise your hand so I'll know who's got that far, got your expenses in. Am I gonna have to separate you two?
Say as soon as we have them all in, did you say?
All the expenses, if you have all the expenses in. Okay, thank you.
Say, who's gonna be in this class? You can sit right here.
Alright. See, I do this kind of stuff, but this is something that you kind of do when you're doing like and I don't wanna mix it up, but like whenever you're doing your own home thing at home, when you're doing an expenses.
Mm-hmm.
Okay.
Okay. Now we're ready to add our expenses, and you'll find you want to use right here because this is where you're going to be pulling over your totals for your expenses. So you want to click down and find where it says total operating expenses. Make sure you're on the right line, total operating expenses, because we want to pull it over to a total column. And the amount, if we were to add them up, is 2240. And then we need to do some analysis. We look at our revenue was 3,400. Our expenses were 2,240. So this tells us that we have a net profit,
Yay!
or net income. So we want to record the difference between the two and identify it. In this case, we have a net income, and the difference is 1160. 1160.
So you made $1,000.
Hey.
It's a start.
It's a start, especially if you're just a new company.
Check your answers.
Don't have payroll in there, don't
That's true.
have.
Oh, I was wondering about withdrawals.
Oh, we haven't gotten there yet. Because that's not an expense. Remember, it's a separate category. Jeffrey, it's a separate category, not an expense. So are we ready to move on? We're going to be creating the statement of owner's equity. Now, the statement of owner's equity does exactly what its title says. It's going to show you the changes that have happened in your capital account during this 2-month period. So again, this statement is covering a period of time, but it's showing the changes that have happened in capital. So we're going to start off, just put our heading in. Sanchez Computer Center. This is a statement of owner's equity, and it is covering a period of time. So it's for the 2 months ended August 31st. You need to press, you need to press continue. Yeah, oh, you got a problem? Just go ahead and click it until it tells you that it will let you go continue. There you go. So you put the company name and then what the statement is, statement of owner's equity, and then for a 2-month period time. Check your answer. Okay, since we're doing the changes that have happened in capital, it says here it's got an icon so you can click your trial balance so you can have it right here. Right. A lot of times they'll have information right above the statement so you don't have to keep looking back and forth. So I click. This is the trial balance that we prepared with all of our accounts because we need to pull some information. Remember this capital account right here, capital. It is the initial investment that happened in Chapter 1 when the guy started his business. He put in $4,500 of cash.
That was in July?
Yes, in July. Since we don't have the regular capital account, so I can go back and check it, because remember I told you there are 4 things that can affect a capital account. The initial investment, additional investment, net income, net loss, and the withdrawal account, where they do the closing process or the temporary accounts. So unless I look back at the capital account, I really don't know if this involves some additional investment or if it's all initial investment. I'm going to have to assume that it's all initial investment since I can't check anything else, okay? So that's important because you need to start off with your capital as of July 1st, when he first started his business. Now, next time, you wouldn't go all the way back to when he started his business. You would be looking at the capital here, and then if you had a capital account so you could check it, you would determine if there's additional investment or not. And the reason that's so important, I want you to turn back to, let me look and see if I can. Well, it doesn't have it. But if there was an additional investment, then you would have a working column here and you would put what his beginning investment was and then add any additional investment that was made during the period that you were doing this statement. Since we only have the initial, this is considered our initial investment, we're going to put it in the total column, $4,500. Now, we're going to put our net income, and we get our net income from the income statement that we just did, this amount right here, okay? Because that affects the changes in capital. The only thing that affects capital is initial investment, additional investment, net income or net loss, and the withdrawal account. So those are the accounts that would be on this statement. So the net income we get from our income statement was $1,160. We're going to subtract from that income any withdrawals that I took out for personal use as an owner. So here's the withdrawals. I took out $100. So it says less, and you're going to put your withdrawal account, or withdrawals for July and August, and put $100. Now you're going to look at these two amounts here, and our net income was larger than our withdrawals. So are we having an increase in capital or a decrease in capital? An increase. So we want to show an increase in capital, and the amount will be, you subtract the $100 from the $1,160, and so the increase to capital is $1,060. $1,060. And so when I add that $1,060 to the $4,500, that's going to be what my capital is as of August 31st. That's my new capital account. And the amount is $5,560. Make sense? Okay.
So when you start a new one, you're actually going to use the August.
Well, yeah, exactly. Because when we post this information through the closing, when we post all this information, then the next time that you look at a trial balance, this capital is going to be this amount, $5,560. Excuse me. I haven't talked this much since, it's been over a week since I had that cold and stuff, but I haven't talked this much, so I haven't been having a coffee. Check your answer. And now we're going to do our final statement, which is a balance sheet. So we're going to start with our title. Second line is always what the statement is. It's a balance sheet. Now, the balance sheet, we're going to use a particular day because on that we can only show on that day that our assets equal liabilities plus owner's equity. So we can only verify on this day this is what is happening.
So that's why.
So we're going to put August 31st. Now we have the type of form we have here is called the accounting form of a balance sheet. We do have what we call a report form. The report form, everything goes down like a report. You'd have your assets, your liabilities, and then owner's equity, capital down here. This is accounting form because you have your assets on the left-hand side, like the accounting equation, and on the right-hand side, you have your liabilities and your owner's equity. Okay? That's just the way it's set up this time. Again, they have the little icon. We can click here so we don't have to keep scrolling back to look at our trial balance, because we will pull information from our trial balance and also for the statement of owner's equity, okay? So we're going to start on the asset side. We have cash, accounts receivable, supplies. Here's all of our assets right here through office equipment. So I'm going to start with cash. And it's $28.65. Accounts receivable, $8.50. Supplies, $4.50. Computer shop equipment. See, nothing has depreciated yet, so we just have the regular asset account, $1,200. And the last one, office equipment, and the amount is $600. I'm going to give you the total. It's $59.65. $59.65. Now we move to our liabilities and we look at our trial balance. We only have one liability, accounts payable. So we'll use the first line, put accounts payable, and the amount is $405. Now, when we get to owner's equity, remember that this date when they are doing this is on August 31st. So we don't want to use this capital amount, this $4,500. That's why we did the statement of owner's equity, to bring our capital up to date. So we want to use this $5,560. So put your capital. And we want to use $5,560. Everybody understand what's going on so far? Everybody okay? Questions? And now when we total, they should equal. So the trial balance, the balance sheet, those statements should equal whenever you get through with them. They should equal. Assets equal liabilities plus owner's equity. Trial balance is checking debits and credits. You want to make sure that they're equal. Uh-oh, what have I got wrong? Oh, pardon?
Oh, from this right here.
Do I have my, oh, I forgot to total, I'm sorry. Total liabilities, excuse me. Total your liabilities. I forgot to do that. There we go. You got a total liabilities, 405.
Okay. 459.
So just say okay, and then right here where it says total liabilities, we need to put 405 there.
You just have to bring the
Yeah, they have a total liability section. A lot of times when there's just one amount, they won't have it. But they did here.
I don't understand why you're adding the accounts payable to the capital.
Because of the accounting equation. Assets equal liabilities plus owner's equity. Okay? Assets equal liabilities plus owner's equity.
I feel like if you know it, you don't have it, so that's.
Because see, Jeffrey, look, on the accounting equation, your liabilities, your creditors have first choice at your assets. You know, let's say that you had to go bankrupt. Your creditors would get first choice of your assets. So then if you did assets minus the 405, then it would equal what your capital is, 5560. Right. So assets minus liabilities equal owner's equity, what you have right of ownership to after your creditors have been paid out of your assets. But the accounting equation, it can be, you know, I showed you it could be shown in several different ways. You can think of it several different ways. But assets equal liabilities plus owner's equity on a balance sheet. Because it's what you owe plus what you have right of ownership to in your capital, 5560. That adds up to all your assets. So we can save this. We're done with this particular
We're saving.
quick save.
Hoorah, we're done.
Now, let's go ahead and we're going to start chapter 3 because it's more doing the same thing. So you'll get practice. You can go back and do the exercises on your own because I've given you enough information. And from what you read in the book, you should be able to do the exercise on their own. I think it's more important that I get through with the Sanchez. Okay, start the Sanchez. So let's go back to do homework.
Yeah, you have to sign back in.
Out too long.
That's
Okay.
activity due to internet.
Sign out, sign in. Just sign out and sign back in.
Chapter 2, is it 3 homework? Which one is it? Did you say chapter 3 homework, Dr. Price?
Yes, why is it not letting me in? Oh, because I'm not using the right password. Yeah, we're going to Sanchez chapter 3. And if you want to have your book open to it,
When I get my book, do you want me to go ahead and?
yeah, you need to so that your balances will be correct, okay?
Just Sanchez chapter 2 and 3.
Well, we probably won't finish chapter 3. You'll see how far we'll get today and just get up to that point if you want to. Okay. It says, consider the following Sanchez Computer Center during July and August, the first 2 months of operation. And so it says, here's the icon to view. These are the transactions that we just did. These were done in chapter 1. We just did these in chapter 2. But now, remember I was telling you we were using the T accounts to help you learn the debits and the credits, okay, and the categories. Now we're going to actually do it as you would in a business. The first place that you enter a transaction is in the general journal, usually called the original book of entry. Okay, so we're going to redo these same transactions, but we're going to do it in general journal form. We still have our same chart of accounts. Let's see. So you may want to have that.
August, or does it say record the September transaction?
No. We're redoing. We're going to do it in general journal form. So we're still doing. This is consider the following, and we're going to be recording the transactions for July and the computer center is yeah. The assignment
one says.
The assignment record the September transactions. We're recording the September transactions. You're right. So I need to go to that's showing us what we did in July and August, and now I need to see this September transactions. Thank you.
Okay.
You're right. Okay. Get rid of that. I'm sorry. We need to go to these transactions.
That's why.
The ones in the book looks like actual documents. If you look on page 116, these are the type of source documents that you would get in the business world.
Oh, yeah, I've seen those.
These would be
That looks more familiar.
These would be like actual checks.
Yes.
These would be like actual invoices. Yes, sir.
sure you accidentally clicked on chapter 3 homework? No.
Just go back.
Well, I don't, it's not gonna make her submit it, is it?
Oh, well, just go down, just go down to save, just go down to save, just gonna save an empty document. So just go back to homework. Homework,
Chapter 3 extensions.
and then go to chapter 3 extensions, okay.
I'm just gonna lose my mind. Y'all find it somewhere, just keep it.
So those are invoices and checks, but they just do it in written form here, okay? So we go through the same process. We're going to read the transactions. I'm going to do the 5 steps, okay? It'll get redundant, but I want, this will help you learn. Okay, paid $1,200 immediately. What do you know when it says paid $1,200?
Cash.
Cash is involved. 2, capital management for 3 months rent in advance. Look at your chart of accounts here. Look over your chart of accounts, see what you got available. We know cash is involved, and then determine what's the other account that would be involved.
Your bank expense.
It would be accounts payable, wouldn't it?
No, because you've already paid it.
Where?
So it has to be an expense.
I don't understand.
Payable, accounts payable means that you're gonna pay it. Accounts payable is what you.
But we
Like
paid,
credit.
When you're trying to credit.
we paid it in advance, so where's,
So it's an asset.
So it has to be rent expense because you've already paid, you've already written the check. The check's already
for
out.
3 months? Yeah, they didn't do prepaid. They should have done prepaid, but they didn't. They just did. Yeah, it should be. Where's prepaid?
It's in there.
Is it here?
Yeah, it's under the postage expense.
I don't see it.
Prepaid rent.
Yeah, it is,
Oh, there.
Where? I'm sorry.
On the little pull down?
underneath.
No, it's probably not on that chart of accounts.
No, it's not on the chart, whenever you pull
No,
down.
it's just on the pull down.
Yeah.
It's on the pull down. Okay, well, it should have been on the chart of accounts. They left that off, okay? Because it's paid in advance. So we've got prepaid rent and we've got cash. Okay, cash. What type of account?
Asset.
An asset. Are you trying to increase it or decrease it? Decrease it. What's the rule?
Credit.
Credit. Okay, we got prepaid insurance. What type of account is it?
Prepaid rent.
I mean, prepaid rent. What's the account?
I thought that was an asset.
It is an asset.
Okay.
Okay, it is an asset. What are you trying to do? Increase it or decrease it?
Income.
Increase it. What's the rule to increase an asset?
Debit.
Debit. Okay, so we have a debit and a credit. Even though they both are increasing or decreasing or whatever, you still will have debits and credits. Okay, so we're going to record September 1. The journal is done chronological. So you're going to have to type in 1 so that you could go back and look at the original book of entry, the general journal, and by dates, and you can see what's happened by each day. And we're going to pull down, we said that we had prepaid rent is our debit. So the debit entry goes first. Debit entry goes first. And then we debit the amount, $1,200. Then we put the credit entry, and we said that was cash, and then we credit. And so this is a little bit easier than the T accounts to actually see there's your debit and there's your credit. So you can see that they're equal right away. Now, if you were doing this manually, which there are some businesses which still do manual accounting, you would put a blank line before you would put in your next transaction. This right here shows a transaction. And then there would be a blank line, and then the next would show a transaction. Okay, the lines would be together and then a blank line between. This one they have us check the answers instead of having a full, so, what have I done? Oh, we gotta do an explanation, I'm sorry. We need to do an explanation of it. Let's see, what do they say here, explain. Explanation will appear on the last line of the journal entry. Okay, so here we go. We click here, and what have we done? We have paid, rent paid in advance. So this is an explanation that you would make. In the real world, and you were doing manual accounting or you were doing QuickBooks, you would only put an explanation if it was something that you couldn't tell from the journal entry itself, exactly what happened, we can look at that and we know immediately we paid rent advance. What would be more important here is to say that we paid rent for 3 months.
We also use check number because you gotta be careful.
You can do that too. You could put check number and put 3 months, or put July through whatever we paid. September, October, November, I guess is what we paid. But that's what would be more important than putting just rent paid in advance. That really doesn't tell me anything. You understand what I'm saying? When you have,
So basically what you're saying, and this, where it says rent paid in advance, is where you would put a specific.
Yes.
yes, I would put it like a check number, like he mentioned, and I'd put from September to November is what my rent was paid, something like that. And they'll only do this the first few lessons, and then they won't ask you to do it anymore. Okay. Okay, now check it. Yes, okay, they like that. Here's our next one. You'll see there's a blank line there, and that we'll put in the second. And on journal pages, if you were doing it manually, a journal sheet is like 11.5 by 8.5 by 11, like a regular piece of typing paper, and that's a full journal page. And so you'd only have to put the year at the top of the page, and then you would just, and the month one time, and then you would just put, like we have here, the next day of that month. When you start a new journal page, then you would put a new year and whatever month that was to start with. Received, what do you know immediately? $325 in cash. Received.
Receivable.
No, received. $325 in cash. You got received cash, okay. For computer upgrade services provided to Tanya Parker. That's a customer, okay. So service revenue. You are in business to repair computers. You did that, and you received $325 cash. What accounts would be involved?
Cash.
Cash,
That's
service revenue, service revenue. Cash, what type of account?
It's an asset.
What are you trying to do to that? Increase it or decrease it?
You're increasing.
Increase it. And what's the rule? Debit. So that's our debit entry. Let's go ahead and put it down, cash. Okay, we said our next one was service revenue. What type of account? Revenue. What are you trying to do to it? Increase it or decrease it? Increase it. What's the rule?
It's a credit.
Credit.
One down.
Last line, put your explanation. Fees earned for cash. Again, what would be more important here would be from Tanya Parker, you know, putting the name of your customer would be more important. If I look back on this transaction, I would want to know that.
That, and I don't know the check number.
And her check number,
Make sure
correct.
they're clear.
Something that if I, in 3 months from now, if I need to go back and look at this original entry, it would tell me something. Okay.
Specifics, I guess that's why I was saying.
Now, what have I done? Oh, I didn't enter the right amount.
Where am I? No. So, there's September.
Okay, the next entry, is everybody with me okay? Are you staying with me? Okay, the next entry is on the 6th. And it says provided computer services to Summer Lipe and received cash of $220. What accounts are involved? Cash and service revenue, okay? Cash, what type of account?
It's an asset.
Asset. What are you doing to it? Increasing or decreasing?
Increase.
Increasing. What's the rule?
Debit.
Debit. So let's put our debit down.
You have number 6 there. I don't know if that matters. But,
Here,
It's 6.
it is a 6.
oh. that's-
And September 6th, right? Okay.
Now I understand. Oh, those are dates. Oh, okay. I thought that was just transaction numbers.
And then our second one we said was service revenue. What type of account?
It's whatever.
Revenue. What are you doing to it?
Increase.
Increasing it? What's the rule?
Credit.
Credit. Put your explanation.
Fee earned for cash.
Mm-hmm. Next one's on the 8th. Okay, paid the phone bill in full for the month of July, and the check was $81. This was back in July when we set it up that we owed it. So if we look back in July and August, it was $85, okay. And we did phone expense at that time, and we did accounts payable. So now we're paying it. So what accounts are involved?
Cash,
Cash?
phone expense.
No. Remember, we received the bill back in last month. And at the time we received the bill, we debited phone expense and we credited accounts payable. Now we're paying what we owe.
So it would be accounts payable.
Accounts payable and
Cash.
cash. Okay. Cash, what type of account? You're going to know cash before you leave here today.
Assets.
It's an asset. What are you doing to it?
Decreasing.
Decreasing it. What's the rule?
It's a credit.
Credit. Okay. And the other one we said was accounts payable. What type of account?
It's a liability.
Liability. What are you doing to it?
Increasing.
Are we increasing that one?
you're
No, we're decreasing that one because we're paying off what we owe. So we're decreasing it. What's the rule?
Let's say debit.
Debit. So let's record our debit entry. Accounts payable.
Oh, wait, accounts payable, sorry.
Oh, it was 155.
That's 85.
The remainder was 185.
Pardon me?
The remainder was 85.
Wait a minute.
I've got 155 in my answer key here, so I think it was
The
155.
electric bill was 85.
Yeah, this was K.
Okay.
Okay, so it's,
159.
yeah, 155.
I'll give you answers.
And we're going to, cash is our credit. Remember, when you get through, always checking debits equal credits. It's easy when you have two accounts. Just remember to always do that when you get to accounts that have more than two accounts. Put your explanation.
Received phone bill?
No, it's paid on
Paid on
account.
account.
Paid on.
Paid on account. Very good.
Ooh.
Oops, I put collected. I want paid. Paid on account.
I said, sorry, not right.
Because you gotta switch it up, man.
You have a split.
Okay, on number 12, let's put 12 in. This again is involving July. It says we collected the full amount from Sparks, and this was transaction O. So let's look at transaction O. She owed us bill clumps $850. $850. So we're collecting all of it. So what accounts are involved? Accounts receivable
Cash.
and cash. Cash, what type of account?
Asset.
Asset, what are we doing to it?
Increase.
What's the rule?
Debit.
Debit, so let's debit it.
We're collecting money from the client.
Okay, the second account we said was accounts receivable. What type of account?
Asset.
Asset, what are we doing to it?
Decrease.
Decreasing it, yeah. Then someone doesn't owe us as much money, so we're decreasing it. What's the rule? Credit. Accounts receivable.
$8.50.
No, $850.
My bad.
Oh, what about, I forgot my explanation. Do your explanation, I always forget to do them. And that one was
Collecting on account.
Collected on account.
count, correct. Okay, I've got about 1218, so we're going to stop with that one, and be sure to save, and we can start with that when we come to class next time. It says you have not completed this, will you receive credit only? Are you sure you want to leave this question? Put yes. Now, to review what you're going to do, I've given you a couple of pages to read in chapter 1, and what that deals with are the financial statements. So I want you to be sure to read those over. I've given you explanations, but you need to read those over in chapter 1. Chapter 1. And just look at your schedule, and it will tell you what pages. Then you're to read all of chapter 2, which goes back over the rules of debits and credits. You need to memorize those. I will give you a drill, not a test, but a drill, so I can see how you're learning your debits and credits. And what that means is I'll give you an account, and you will tell me what side of the account is a debit and credit, and what side you increase and decrease on. That's what I'm talking about, your rules. So if you remember AWE and LCR, you should be able to remember those, okay? in chapter 2 goes over again the financial statements, and then in chapter 3 it starts with about how to journalize, which we've started already. So you can just sort of read through that so you can understand what we're going to be going over.
So chapters 1 through 3.
Well, just certain pages in chapter 1, because I don't want you to get confused with the accounting equation, the way they do it. So only do the pages in chapter 1 I've told you to do, and then all of 2 and 3. Okay, no one's going to drop, right?
Not yet.
Good, I think y'all are getting a handle on it. That's great.
Oh, so we're not doing any typing at home, not yet. We're just gonna be reading at home. Make sure we
Yes.
read.
Oh, well, you can do the exercises in chapter 2.
Play
I would-
around with it.
Yeah,
Okay.
go in and you can do your exercises for chapter 2 for sure. And if you feel comfortable doing your homework in chapter 2, you can go ahead and get started on your homework in chapter 2, okay? Okay. Be sure to go through your 5 steps. And if you get stuck on general, when you're thinking about the journal entries, always resort back to your T account, drawing a simple little T account.
This is, okay, that's why I'm looking at this. So we're on 5.
Your assets increase, the amount of how much you bought a
Car is an asset.
Yeah, because you bought a, say you bought a 27